Good morning and welcome to the Killik & Co market update. This week we've been looking at some strong manufacturing data for developed economies for December, and in particular we're looking at something called the PMI survey. So this stands for Purchasing Managers Indices, and it's basically a survey that interviews a number of different purchasing managers and asks them if they think their business will expand or contract over the short-term future. And these results are collated into a score between 0 and 100, and basically anything over 50 means that their sector is expanding at the moment. Normally the results are fairly clustered around the 50 level, so anything slightly above 50 we would view as a good sign. You can have different PMI surveys for different sectors. For example, there is one for services, and this week we're looking at the one specifically for manufacturing. So here are the results for a number of major economies. As you can see, the US has come in at 55.1. That's a very good number indeed, and that shows that, as we know, the US economy is doing well, and it does perhaps suggest that Trump's plan to move more manufacturing jobs back to the US has been paying off so far. Then Europe came in even higher at 60.6, particularly powered by Germany. Germany has always been a very strong industrial and manufacturing country, and that is definitely true at the moment. And even the UK at 56.3 was higher than expected, and this is perhaps because sterling is so weak that goods manufactured in the UK do look quite cheap and quite attractive to overseas buyers. So we have seen an increase in demand there, and that has led to an expansion in our manufacturing sector. However, if you compare these to the global average, that only came in at 50.9. So that does imply that there are some other major countries who are bringing that average down a bit. And in particular, China is experiencing quite low numbers at the moment. And that's because China is moving away from the developing stage of its economy. It's moving away from manufacturing, and it's trying to move more towards consumption and services. So that's why the manufacturing PMI for China hasn't been quite as high as it has been in the past. And this strength in manufacturing is perhaps one of the reasons why we've seen a recovery in global commodity prices recently. 2017 was a surprisingly strong year for commodities, and that has carried on into 2018 so far. And this is quite surprising, bearing in mind that 2016 was said to be the worst start to a trading year ever, and that was really caused by strong weakness in commodities. This example here is the Brent crude oil chart over the last 5 years. So as you can see, the price started at over $100 a barrel back in 2014, but then between 2014 and 2015, it more than halved in value, and between 2015 and 2016, it more than halved again. So by the beginning of 2016, it was just $27 per barrel. But as you can see, it has recovered quite strongly since then, particularly throughout 2017, and actually this week it hit $70 per barrel for the first time since 2014. So that's definitely been a positive thing for oil stocks. We've also seen global mining stocks recovering a lot of their lost value, partly because major commodities such as iron ore have recovered some of the value they lost in 2016, but also because mining companies have been focusing more on the commodities that will be used more in the future, and some of these have really undergone quite significant price rises in recent months. For example, we've got zinc, cobalt and copper. These all underwent very significant price rises in 2017. So zinc, which is used in batteries as well as pharmaceuticals and cosmetics, that was up 30% in 2017. Cobalt, again used in batteries, that was up 129%, and copper, which is used in the national grid and also in electric cars, that was up 31%. So miners refocusing on these particular commodities will have done incredibly well. And that is a reason why the FTSE 350 mining index, which is basically just the mining companies within the FTSE 350, that has risen quite significantly since 2015. So as you can see by the chart here, it's gone from just over 5,000 in late 2015, early 2016 to just below 20,000 today. So that really is quite a significant rise. So there have been quite significant recent price rises in commodities, and particularly for oil, and a lot of people are asking, where does the price go from here? It's a very difficult question to answer, but what we can do is look at the futures market to gauge an idea of where investors think the price is heading next. A financial future is basically a contract or a legal agreement to buy or sell a particular commodity at a predetermined price at a specific time in the future. So if we look at this market and we see that people are going into more buy futures contracts than they are sell futures contracts, that lets us know that people expect the price of the commodity in question to rise. And what we can do is add up all the futures contracts to buy and subtract all the futures contracts to sell, and that gives us something called the net long futures position. And the higher that value is, the more positive that suggests investors are about the future price of that particular commodity. So what we've done here with this chart is show the net long futures contracts for oil versus the actual price of oil over the last 5 years. So the green line shows the price of oil. So that's the chart we just looked at. That shows oil above $100 a barrel in 2014, falling to $27 per barrel in 2016. And then the pink line shows the net long futures contracts. So as you can see, just after the oil fell to $27 per barrel in 2016, there was quite a huge spike in the net long position, suggesting that people were buying in because they thought the price would go up from there. But what's interesting now is that again, in 2018, the net long futures position has once more risen. So that does imply that many investors think that the price of oil will go up from here. Very difficult to say. We will have to wait and see. Moving on to the week ahead, we are just moving into Q4 reporting season, so we are expecting to have an increase in the number of companies reporting. But in particular next week, we will be looking out for some of the US banks, particularly Citigroup and US Bancorp and Goldman Sachs. That's it from us. Have a great weekend, and we'll see you next Friday.